We are here at NSE as Wakefit gets listed today. The company known for its mattresses-led D2C model. Now the company is also expanded into furniture and homegrown accessories. Now what to expect post-listing? Joining me to talk more on this is Ankit Garg, who is the co-founder and CEO at Wakefit.
Hi,
thank you for speaking to NDTV Profit. Ankit, I want to start by asking you that post-listing, how do you read the consumption, the demand side in your core categories, especially the mattresses, furniture, especially when the discretionary consumption is still uneven?
Yeah, so I think fair question. We have seen in the recent past, for the last 2 years, there has been there's been a constraint in terms of people spending money. But we are a very small company from that point. I want to convey this message to you that the category under which we are playing, it's a 3 lakh crore size industry in India, and we are not even 1% of that industry. So hence, we feel that for us, the growth is not going to come from whether the consumption improves from the 3 lakh to 3.5 lakh or whatever. We have to go for market share. We have to do much better in terms of offering our products to consumers. So I believe there's a lot of headroom for us to grow instead of depending on the sentiment.
Yeah, and what will your revenue mix look like in furniture, mattresses, and home accessories, and how will it evolve in the next 2 years?
Yeah, we in mattresses we had about 60% share of the overall revenue, and then then was the furniture, and then was the accessories. We had reported in our RSP document as well. But we foresee that furniture is expanding at a much faster speed because of the small base. Obviously, percentages wise, if you look at it, furniture is smaller in percentages, but furniture market TAM is also 10x the mattress market TAM, and hence we feel in the next 3 years we might become almost equal to 50-50 or somewhere close to that. But I believe that mattress will continue to see a very healthy growth. As of today, it's growing at about 25%. I believe that for the next 2 to 3 years, it should continue to grow at a similar level, while furniture might outgrow mattresses, and hence eventually mattress share might come equal to furniture and decor furnishing.
Your revenue has really picked up with more than 1,200 crore, and now the profitability has also picked up recently. What makes you confident that this growth will be sustainable in the long run?
Yeah, so this goes back to the roots. This goes back to the fundamentals of the company on which we are built. If you notice, we've been compounding for this 25%, 28% over the last 3 years. In the beginning, we have been compounding at 100% growth, 50% growth. So growth has never been a challenge because of the fundamentals. We believe that we are a D2C omni-channel backward integrated brand. I'll tell you, elaborate more about it. Why D2C? We started a D2C company. We had our own website in 2016 when we launched it. Eventually, we got into Coco stores, company-owned, company-operated stores. So we became omni-channel company also. And then we also from day one were backward integrated, which means that we had factories. We today operate about 6 factories ourselves. We operate about 28 large warehouses ourselves. We manage close to 6,000 folks directly, indirectly, from Wakefit side. So what we have done is we have gone and invested a lot of energy resources in building the pillars, so-called pillars, which is manufacturing pillar, engineering pillar, design pillar, retail pillar, logistics pillar, brand as a pillar, and all of them are now compounding together, which is giving us this push in terms of giving great products to consumer at a very low price. So I think this will continue to prosper for Wakefit. We believe we have to just continue to do what we have been doing in the recent past, and hence growth pressure doesn't even come to our mind.
When we talk about raw materials for your industry, foam, steel, wood, logistics, all these are very volatile. Now, how do you manage the input cost risk, and realistically, would you have any pricing power in the current market?
See, I think another benefit of D2C, omnichannel company, is that the capability to pass on the pricing to consumers in case, let's say, there's an increase in price of raw materials. Similarly, there is a decrease in price of raw materials. Your capability to pass on the prices overnight. It's just one click and everywhere the prices are updated. So hence, we've seen that there is a lot of reception into our consumers when they understand there are inflation of 5%, 6%, 8% raw materials. We've seen over the period of time gradually we pass on every tiny bit percentage in a quarterly form, and hence people don't feel inflation coming in, kicking in a very absurd manner. Like, we have been very consistent in making sure that any increase or decrease in raw material prices should be passed on to consumers in a very gradual form to our customers.
In your home and furniture space, there's a lot of competition with IKEA, Pepperfry, and many other newer players coming. So what is that unique value proposition which you get on the table, and how do you manage your cost efficiency?
Compared to competition, we have built our company slightly differently. I think we are the only company maybe in the competition who owns the factories, which I said, right? We operate 5 to 6 factories. We're the only company who has predominant online share of business. Like we are served to 90,000 mid codes of India, while there are companies who are, let's say, geographically restricted to sell only in some specific pin codes and stuff. So we, by virtue of the way that we have designed our business, which is heavy on factories, heavy on retail store operating ourselves, heavy on online, heavy on building a brand multi-category. If you notice that in our category there are mattress independent players, there are furniture independent players, there are furnishing decor independent players. But we are the only company who has built these 3 categories. All of them are sizable. All of them are 150 crore plus of businesses, which means they compound each other. Let's say you as a customer, you would buy a bed sheet, let's say at some point in time with us. Eventually you will buy, let's say, a crockery set, then you will buy a wall clock, then maybe at some point in time sofa, at some point in time, let's say, a mattress. So we make sure that every year there's a reason for you to come to us and buy from us, which makes us quite unique. And for all of this, we are proud to say that 99% of the products that we sell, we manufacture in-house, which means we command quality, we command inventory controls, we command pricing, we command the speed, the agility at which the company operates. So hence, this makes us a little bit unique compared to our competition, and I feel that we should kind of thrive on this.
You have over 100 plus offline stores now across India. How do you see the profitability on store level, and how do you basically, what's the typical payback period for this?
See, currently our payback period is less than 12 months. We are very, very healthy compared to a standard traditional playbook that we have seen in the retail market. ROCs are way too good, and hence we have as an outcome continued to open more and more stores. In fact, the proceeds that we're taking from IPO is also one of the reasons to expand many retail stores.
Will be used over there.
Yeah.
Now, if we look at the IPO itself, the retailers have shown a lot of interest. When we come to institutional investors, there has been measured interest. Now, how do you see this investor sentiment with the post-listing trading, and how do you see this will sustain forward?
See, as a CEO, as a founder of this company, my job is to just focus more and more values to be added to our customers. I am a very strong believer that the values only get created in long term. And for that long term, we have to really do a lot of good stuff at the right time with a lot of right intent and allocation of resources. So I believe any investor of any form, if they continue to bet on us for a long term, I'm sure we'll create tremendous value for them.
A very important aspect in your business for D2C brands is marketing. Now, how will the change in technology affect your operating leverage, and what are your plans for marketing specifically?
See, Wakefit is one of those unique brand because we happened in 2015-16. We have learned how marketing as a game has evolved over a period of time, and we have also built a very strong muscle in terms of discipline. Today, when we notice a lot of D2C companies, they end up spending a lot of money. But Wakefit, in the last 8 years, if you notice, we have been always operating within 7% to 9% of top line of marketing costs, which is very, very healthy. And the outcome of this cost is very fundamental. Again, if you offer right products to consumers at right prices, you offer them value, they end up talking to their friends and families and colleagues wherever they meet them. And hence, word of mouth, the referral business is the largest part of our business. We continue to grow by 25%, 30% year on year, because larger part of this growth comes from the same customer who's referred his friend or a family or a colleague, right? In fact, we are very happy to mention that a repeat rate from a customer is more than 35%, which means that even though when we operate in a category like mattresses or furniture, which you buy once in 5 years, once in 10 years, but every year you come buy from us, which means that if I acquire a customer at the age of 20 to 23, until they are 40, 45, they're relevant to us, they'll continue to buy things from us. And hence, we acquire you once, but continue to sell more and more. Hence, percentage costs are very low. So we have built our system very differently, I would say, so that we keep the cost in check and we make sure we compound on more word of mouth than marketing costs.
Lastly, what are your, if you have any targets in mind with respect to your growth, the profitability, margins and cash flows, and also what's your vision for the company in the next 5 years?
See, we want to be that destination, we can call it, let's say how decathlon for sports. let's say how Amazon for everything that you want to buy, how let's say First Cry for kids products. We want to be that Amazon of home. Anything that you want to buy for your home, we want to become that company. That's the aspiration.
All right. Thank you so much for speaking to NDTV Profit.
Thank you.
Thank you, Ankit.